So our next stock, Todd, this is a stock called Synergy Pharmaceuticals. This is ticker symbol SGYP. This is a biopharma stock that has had its eyes set on the very highly lucrative and very competitive gastrointestinal space. And it has its lead drug, Trulance, that was actually approved in 2 GI indications going back to early 2017. They got approved for their second indication earlier this year. I took a look at this stock. Right now, the stock is sitting at about, believe it or not, 39 cents a share. That's down 85% on the year. And really, Todd, this stock is another classic example of where marketing approval is really only the beginning. Commercialization is a much larger, much bigger beast that's much tougher to conquer.
Absolutely. Clinical stage stocks, they'll rally up, they'll rally down, they'll trade a lot on excitement and peak sales forecasts and all that stuff. Then when it gets to rubber meets the road, and you actually have to prove that out by winning over payers and getting in front of doctors. It's a very different ball game. A lot of companies struggle to do it, and that's why they go out and they get licensing partners. You know, Trulance competes against Ironwood's Linzess, and Linzess is paired up, or Ironwood's paired up on that drug with Allergan, which is of course a huge company with plenty of deep pockets that can market the drug and get it in front of people, and swing a big stick when it's talking to different payers to get formulary coverage that is better than what Synergy could do with Trulance. And Shannon, the scary thing here for investors really is the disclosure recently that Synergy's having a very difficult time in refinancing its debt, and that has increase the risk that this company's operating expenses are just so high that it's going to burn through the remaining cash that it has. If it can't renegotiate, then it could be called into default because currently it doesn't meet the covenants on the debt that it owes. And of course, that would be bad news for shareholders and obviously the employees of the company, and for patients, because they'd lose potentially access to what could very well be a fine drug that would work very well for them.
Yeah. And so I think between the go it alone strategy, I know back in, I believe it was 2015, the company was attempting to find a partner, potentially even a buyer. And according to the company, there weren't any offers that they thought really met the value of what Trulance was offering and for the value of the company. So there was no buyer, no partnership. You mentioned too the other issue, and that's related to these loan agreements. You've got sales and liquidity covenants that the company is currently not meeting, which puts it in a particularly dire place. There was the business update that they provided recently. And honestly, that was probably one of the saddest, most depressing business updates I think I've ever read, because ultimately it came down to we are very close and on the verge of bankruptcy is what I got from that. And so another thing I want to go back to is that you mentioned with Linzess and Ironwood and Allergan, this is a very competitive space, and you've got very deep-pocketed competitors who have a very strong commercial sales force, and now you're attempting to come onto the market alone. You don't have a deep-pocketed partner that can really help offset some of these costs and really get you across the finish line. And so what you see happening with Synergy is, I think, a classic tale of, for these small biotechs, you've got to have a big partner, especially in competitive spaces like GI.
Yeah. And, again, to lessons learned or the warning signs, what were those creaking doors? What were those voices saying to us that maybe would have helped us to avoid investing in Synergy? I think the things to bear in mind are, rapid cash burn, how quickly are operating expenses and R&D drawing down the cash that you have on your balance sheet? How often are these companies going out and having to tap investors for dilutive equity? And then if they're not able to do that, do they owe money through loans to other third parties that aren't your traditional banks that are providing liquidity? Do they have, are they converts? Are they preferreds? Do they have, interest rates that are, in case of Synergy, 9.5%? Obviously, lenders were not very willing to front up at favorable rates money to this company. So maybe that's a warning sign. So just pay attention, listeners, to how much debt companies have on the balance sheet, how much cash they have, how quickly they're going through that cash, and where they're getting the funding that they need to keep going.
Fair enough. And Todd, I'm going to throw out another warning sign. You tell me if you think this is a warning sign. But this was actually the company that was behind the infamous poop troop. And excuse my language, I'm not making that up. This is literally the, I guess, marketing ploy the company went after in 2017, where they created this pack of, I guess, emojis really designed to increase the conversations around constipation. Weirdest, strangest thing I think I've ever seen, Todd. Was that a warning sign in your eyes?
Could be. I mean, someone took a swing and unfortunately a miss in the marketing department on that one.
That is for sure. And certainly not enough to keep this stock out of the toilet. Yes, I did go there.